Monthly dividend income is attractive to investors for obvious reasons. Having an income stream that's very close to what you could expect at a normal job is great, but there are very few monthly dividend companies that are actually worth buying. Realty Income is a monthly dividend REIT currently trading at a huge discount, down over 25% off their early 2020 high, and in this video I'm going to show you why I'm buying up as much as I can. Many businesses will pay monthly dividends as a percentage of revenue, like San Juan Basin or Petro Brazil. The problem with these companies is they don't increase their dividends consistently, and compounding can never take place. Realty Income is one of the only companies that both pays monthly dividends and has consistently raised their dividend for multiple decades. Let's take a deep dive into this REIT and see if it belongs in your dividend portfolio. Realty Income Corporation, ticker symbol O, often referred to as the monthly dividend company, is a real estate investment trust that generates income through a diversified portfolio of properties. Their unique investment approach has allowed Realty Income to establish itself as a reliable source of dividends for investors while weathering market fluctuations. Realty Income is renowned for its significant holdings in retail properties, which include standalone stores, shopping centers, and convenience stores. The company benefits from long-term lease agreements with well-known retail tenants, ensuring a consistent stream of rental income. While the retail sector has faced challenges due to the rise of e-commerce, Realty Income's focus on essential and service-oriented businesses has positioned it to remain resilient in this evolving landscape. Realty Income has strategically invested in properties leased to supermarket chains and pharmacies, which provide essential goods and services. This sector has demonstrated stability as these properties are often located in prime locations and cater to everyday needs. The demand for these properties is expected to remain robust, contributing to Realty Income's sustained income generation. Another segment of Realty Income's portfolio includes convenience stores and dollar stores. These establishments serve local communities and tend to maintain steady foot traffic. With a focus on properties leased to established chains, Realty Income is well positioned to capitalize on the consistent consumer demand for convenience and value. Realty Income's portfolio diversification across various real estate sectors underscores its resilience and adaptability. The company's focus on essential businesses, service-oriented establishments, and community-centric properties bodes well for its income generation potential. As the economy continues to evolve, Realty Income's strategic investments in sectors that cater to essential needs provide a solid foundation for long-term growth. Realty Income's ability to generate revenue from a diverse range of properties, coupled with its strategic positioning in sectors with resilient demand, makes it a compelling investment option. The company's commitment to providing consistent dividends further solidifies its status as a dependable income generator in the world of real estate investment. O's current dividend yield is 5.18%, which is about 15% higher than their 5-year average yield of 4.5%. Realty Income's 10-year dividend growth rate is 4% and their 3-year dividend growth rate is 5.1%, indicating they're increasing their dividend growth. O has raised their dividend every year for the past 30 years, making them a dividend champion. Realty Income has posted negative free cash flow every year over the past 5 years, mostly due to heavy investment in new property acquisitions, which we'll cover more in depth later in the video. Since all of Realty Income's assets are real estate, they're also able to depreciate a significant portion of their net income, leading to high net income payout ratios. This really just means that net income isn't the best metric to measure dividend safety, so we'll look at operating cash flow ratios instead, which have remained below 89% since 2018. O has had strong financial growth over the past 5 years, with net income growing at 25%, operating income growing at 32.5%, operating cash flow growing at 41%, and free cash flow declining at 154%. If we invest $1,000 in O today with an initial yield of 5.18%, 5% dividend growth, and 5% share price appreciation, our yield on cost after 20 years would be 30% and our average annual return would be 9.5%. Over 20 years, $2,700 would have been paid and we would earn $310 on the 20th year. The current interest rate environment and investor sentiment around the real estate market has pushed down the share price of many real estate investment trusts, including Realty Income. At this point, most people are aware of the strain being placed on small retailers by e-commerce and outlets like Amazon. I would be worried about Realty Income's outlook if they weren't positioned to weather these difficulties in their portfolio allocation. Most of the retail businesses they lease to have not been impacted by e-commerce and stand to grow steadily over the coming decades. Additionally, O does not own any residential properties, so if you're worried about declining home prices or unfinished apartment complexes, you can rest assured this will not impact Realty Income's portfolio. They've also maintained an extremely high occupancy rate, currently at 99%, for over 3 decades. This comes as a result of their focus on long-term lease agreements and a commercial client base. The consistently negative free cash flow is mostly a product of large acquisition costs over the past several years. Between 2019 and 2023, Realty Income increased their total assets from about $18.5 billion to nearly $50 billion. Total debt has also increased over that time frame from $8.36 billion to almost $20 billion, indicating the business is investing heavily in new properties to boost overall revenue. This strategy is obviously working since their operating cash flow is trending up at over 40% per year. To lower tax burden, Realty Income reduces net income through depreciation of their assets. The low net income results in a high payout ratio, but this is a misleading indicator. This leads us to analyze the dividend safety almost exclusively on an operating cash flow basis. Looking at the operating cash flow, we find the payout ratios rest around 80%, which is high, but reasonable. Given their REIT status and high distributions, I'm comfortable with these numbers. During the pandemic, O dropped under $50 per share but quickly rebounded to $60 by the middle of the year. The stock traded up to $75 in early 2022, but hasn't reached their pre-pandemic peak of about $80 per share. Given their strong financial growth and resilient diversification in the real estate sector, I'm expecting both strong dividend distributions and share price growth over the next couple years, making right now an excellent entry point for most dividend investors. If you like this video, check out our most recent analysis outlining the top 5 best tech stocks for 2023, which you can watch by clicking the video card here or in the description. Make sure you hit the like and subscribe button for the YouTube algorithm. Until next time, stay safe and take it easy.